This jobs report represents a crucial pivot point in our economy. Based on its outcome, this could spark a change in Fed policy and ultimately the financial markets. We're going to show you the true state of the jobs market from the other employment figures rarely discussed. We also look back in time to the last major Fed pivot, so we now know what to expect this time around. We've also done some math. Based on the current trend in the jobs market, we're going to show you our predictions. Let's first consider the other jobs numbers that reveal so much about our employment sector. The ADP total payrolls refers to the total number of employed individuals in the private sector. On a year-over-year basis, this figure has consistently declined to a current meager 1.8%, falling from a lofty 5.6% just a few years ago. Of course, in the midst of the decline, there are certainly outliers to this weakness, such as the payrolls within financial activities. While only registering a 0.2% year-over-year gain in July of last year, the number has improved to 1.3%, establishing a 5-month high. With that said, the overall ADP report does have quite the negative tone, especially within the manufacturing sector. Annual returns now stand at 1% in the negative territory. In fact, the current report represents the 8th consecutive loss. There's also a real hidden weak trend in the non-farm payroll report itself that most simply overlook. In just a moment, you'll see exactly what that is. But let's take just a second to consider the Job Openings and Labor Turnover Survey, otherwise known as the JOLTS report. This collects data from the employers to measure aspects of the labor market such as job openings, hires, quits, and layoffs. From a sky-high 56% reading achieved in 22, the current report of job openings now stands at a 15% loss on a year-over-year basis. The sheer number of hires has also precipitously declined over the past few years. From a soaring 18%, the annual change now stands at a minus 11. The number of those individuals quitting jobs has remained in negative territory for nearly 2 years now. The quits figure now registers a 16% decline from the previous year. Perhaps a bright spot on the JOLTS report this month, the number of layoffs has fallen below zero for the first time in quite a while. In fact, this month's update represents a 16% decline from the same time last year. But that's not why we're really here. We're here to talk about the much anticipated non-farm payrolls, and we're going to show you our projections. At first glance, it appears as though this figure has steadily improved over time, with last month's gain of 157,700. But comparing one month to the next may not give us an accurate assessment of the data. It is more helpful to compare this February to February of last year to understand the true change in the economy. Here we see in blue the non-farm payrolls has actually steadily declined over time. Why is this important? Just the other day, Atlanta Fed President Bostic, the U.S. Federal Reserve is under no urgent pressure to cut interest rates given a prospering economy and job market. Well, that begs the question. At what point would the job market not look so good? What type of job market would compel the Fed to cut rates? Perhaps history has the answer. We turn the clocks back to the days of 2007, at which point the Fed funds rate stood at 525. In the latter part of 2007, the jobs market weakened to a point where the Fed was finally compelled to cut rates. This reduction in borrowing costs took place when the non-farm payroll sat at a meager 1% on a year-over-year basis. So where are we now? Has the non-farm payroll year-over-year returns declined enough to compel the Fed to cut rates? Well, we know, not according to the Fed. Over the past few months, the jobs report has returned to a 1.9% level where it stood for several months now. With this assumption, the trend continues. What may we expect from Friday's update? Again, the current trend indicates the non-farm payroll is rising at an annual pace of 1.9%. Given the jobs number from February of last year that was reported at a little over 155,000, this indicates if the 1.9% rate persists, that would put Friday's number at 158,000. So what's the takeaway? How can we use this moving forward? If the jobs number disappoints, perhaps the Fed will reconsider rate cuts sooner than expected. Stocks certainly would like the prospect of lower rates, but here's the rub. If the number is weak, it has to be weak enough to compel the Fed to cut rates. If the number is mildly weak, the stock market may not like the idea of high rates and a weakening economy. If the jobs number is strong, the Fed certainly has no reason to cut rates, at least not anytime soon. If that's the case, the stock market will want to see a good reason to be optimistic. If that number is strong, it should be very strong. So, in light, a big surprise would be a good surprise, but any moderate report may be taken as a disappointment to the markets. Of course, the Fed futures will give us a better clue. We'll be sure to revisit these numbers and the market's reaction after the fact as well. We thank you for joining us. We look forward to seeing you back soon.